A company's financial statements are the window through which we can look to learn all about the business. Is it profitable and growing? If not, is it on the path to becoming so? What kind of assets does it own? And how has it financed the purchase of those assets? Is it generating cash? And if not, does it have enough to survive for at least the foreseeable future? What is its ownership structure? And how has that changed over time? All of these questions and many more can be answered when you understand how to read the company's financial statements. But the fact is that unless you have a deep background in accounting or finance, and even sometimes when you do, it can be a bit intimidating to read financial statements. They can be quite long. There's a wall of numbers thrown at you, and if we're being honest, they're rarely an exciting thing to read through. So in our series here on reading financial statements, our goal is a simple one. We want to help anyone that's felt a bit overwhelmed when it comes to working through a company's books. And by the end of these 9 episodes, you'll be reading financial statements with confidence. Now, to accomplish that goal, we'll break things down and take them one piece at a time, so we can learn each individual component in detail. And as we do so, we'll naturally uncover how all of these components work together to form a complete set of financial statements. And I want to promise you that in this series, we're not going to bury you in accounting jargon and technical rules. We have plenty of series to watch if you want a deeper dive into technical accounting and finance. Instead, our focus here will be on the financial statements themselves and how they work together to tell the complete financial story of a business. And the bulk of that financial story is told through 5 different chapters, and we'll walk through each by the end of this series. There are 4 core financial statements, and then a 5th piece that's just as important, the notes to the financial statements. So we'll get to the notes in a bit, but let's start with a high-level discussion on the 4 statements themselves. And while these 4 statements are individual reports that are included together in a complete set of financial statements, the way I really want you to think about them is as 4 different lenses, each looking at the same business, but each focused on a slightly different story. Each of these 4 lenses will show us something that the others can't, and it's only when we look through all 4 that we can see the complete financial picture of a business. So what are these 4 statements? Well, the first is the income statement, which you'll also hear referred to as profit and loss or P&L, or sometimes as the statement of operations. This report answers one very simple question. Over some period, say a month, a quarter, or a year, did the company earn a profit? Did they earn more in revenue than they spent? So when it comes to the question of whether a company is profitable, this statement is the lens we want to look through. Now, technically speaking, as part of a full set of financial statements, the income statement is actually part of a slightly bigger statement called the Statement of Comprehensive Income. The income statement itself gets us to a figure called net income, and then there are a handful of special items that get added after to arrive at a figure called comprehensive income. US GAAP allows companies to present these as either one combined statement or 2 separate ones. But don't get too hung up on that yet. We'll come back to comprehensive income when we get to the statement of shareholders' equity, because the running total of those extra items ends up living inside equity. And the equity statement is where we'll see it most clearly. For now, stay focused on the income statement, which we can use to determine whether a business turned a profit or not. Then the second lens we can look through is the balance sheet, formerly referred to most often as the Statement of Financial Position. And the balance sheet answers a completely different question. Here we can learn, what does the company own and what does it owe? While the income statement is presented over a period of time, did we earn a profit this quarter or this year? The balance sheet is presented at a single moment in time. If you froze the business right then and took full inventory of all its possessions, the balance sheet is an organized snapshot of those possessions, along with the other side. What does it owe to others in loans or invoices it hasn't yet paid? Then the third lens is the Statement of Stockholders' Equity, alternatively referred to as the Statement of Shareholders' Equity or the Statement of Changes in Stockholders' Equity, or for a business that is not a corporation, the Statement of Owner's Equity. All of those titles refer to the same report, and here we're after one fundamental question. How did the owner's stake in the business change over the period? Like the income statement, this is a report that shows activity over a period of time, instead of at a point in time like the balance sheet. A business is funded in part by its owners, and that ownership stake grows and shrinks over time. It can grow as the business earns profits or owners invest more, or shrink when the company pays out dividends or has a loss in a period. And the statement of stockholders' equity is the lens that tracks those changes, and it tells the story of the owner's piece of the business. Then the fourth and final primary statement is cash flow, formerly referred to as the statement of cash flows. And this report answers the most down-to-earth question of them all. Did our bank account grow or shrink, and why? Recall that when discussing the income statement, I said it answers the question of whether we earned a profit. And that language was subtle but intentional. I didn't ask whether it made money. I asked whether it made a profit. Because of accrual accounting under US GAAP, along with financing decisions made by management, the answers to these two questions may not always point in the same direction. It's certainly possible that we earn a profit, but during that same period experience a net cash outflow, or vice versa. This gap between profit and cash will be one of the most important ideas to keep in mind as we learn to read financial statements. And the cash flow statement is where we look when we want to understand how the company's cash balance changed and reconcile that against the net income reported on their income statement. So those are the four individual statements we'll cover in this series, and they all work together to tell us the financial story of a business. But as I mentioned earlier, there is a fifth piece as well, the notes to the financial statements, and any complete financial reporting must include them. In fact, generally the bulk of the financial reporting will be made up of the notes. The notes are in-depth explanations of the high-level numbers on the four primary reports we just discussed. The four statements alone tell you what happened, but the notes dive into the how and why. So we'll spend an entire episode focused on the notes near the end of the series, because you can't fully understand the financial statements without them. And that's our full roadmap for this series. We'll work through each of the four individual statements, look at the notes, and along the way we'll discover how each of these work together to tell the full financial story of a company. So in the next episode, we'll introduce a simple fictional company we'll use to illustrate our discussion and dive into the income statement.